So we wanted to just dive in today about, what to expect when you're buying a home for a first time, or this information is going to apply to anybody really that's going through the home purchasing process of what options, just to be informative and hopefully you learn something. Hello, welcome. I'm TJ Shimmick with Team Shimmick Real Estate and the Mitten Group. Today we're here with Todd Gerald. He's a local lender here in Traverse City, covers all the northern Michigan area and a few other states as well, right, Todd?
Yep. Yeah, Florida, Wisconsin, Indiana, and Illinois.
Great. Awesome. Todd, tell us a little bit how long you've been in the business, a little personal background about yourself.
Yeah, I went to college at Michigan State and then went right into the mortgage business, believe it or not. So been doing that now for better part of 20 years as of next year.
All right.
On and off with a few different lenders, but it's coming upon the big 20.
Nice. We deal a lot with first-time home buyers. We want to dive deep a little bit into what they need to know. So from a lender's perspective, what should first-time home buyers know before really starting the process? Like, what information do you need from them to, I guess, give them the information they need to understand if they can afford this home or what their payments might need to be?
Yeah, I think the most important thing for a first-time home buyer when they're first looking into whether or not it makes sense for them to purchase is to determine what they can afford on a monthly basis within their budget. If they're currently paying rent, can they afford any more than the rent that they're currently paying? That's the number one goal that I ask clients when I talk to them initially is I'll look at your qualifications and determine what you qualify for. But if we ultimately need to determine what you feel comfortable qualifying for or what you feel comfortable paying on a monthly basis. So it's really the monthly payment budget that is the number one goal.
Okay. So if I come to you at first-time home buyer and I'm comfortable for $1,500 a month, like what information do you need from me to see if I qualify for a $1,500 a month mortgage payment?
Yeah, the first thing we look at is the credit score, the credit profile, the amount of
hard credit, or
no. So we start with a soft credit inquiry. Okay. We do that with all of our pre-approvals up front, and then once you go under contract on a home is when we do the hard inquiry. But the soft inquiry gives us all the information we need from the credit score to the outstanding debt that you have on your credit report, any derogatory items that might impact your pre-approval or your qualifications. What would be a derogatory item? Late payments on other debt such as credit cards, car loans. Past bankruptcies or foreclosures. Probably not a foreclosure if you're a first-time home buyer. But any collection accounts, bills that you have maybe forgot to pay or went into collection. So we do the soft inquiry first. That does not impact the score. So there's no hard pull on the credit score. Sure. And that's a relatively newer benefit to the industry here just in the last year or two.
Oh, okay. That's the first I've heard of that.
Yeah. So we do a soft credit pull. We like to dig into the income, whether it be employee of a company, self-employed, the length of the employment, the amount of the wage or the salary that you earn, the amount of hours that you work if you're an hourly employee. We like to dig in deep to really understand the continuance of the income. Okay. The continuance of the income derives the ability to repay the debt, meaning the mortgage. And so we want to make sure that there's a continuance there. And the thing that we kind of run into at times is if there's a lot of variable hours or any variables to any income source, it makes it higher risk. Okay. And in turn, we need to have a little bit more information.
So I was going to ask, what are the minimums, like credit score minimum, how many hours minimum? Mm-hmm. Tell us about those two.
Yeah, so the credit score minimums, that has evolved quite a bit here in the last couple of years, where it used to be a hard stop at 620 as far as a FICO score. Okay. And then it went down to 580, and we actually have some programs now that are less than 580 as well. So the credit piece is kind of the biggest variable, the biggest challenge, the biggest hurdle that I would say is the number one thing we look at. Okay. And that one is hard to kind of nail down as far as pass or fail, because there's a lot of things that go into it as far as the overall profile of the client.
I know there's a lot of different companies that spit out credit scores. You're looking at just at FICO?
Yep.
Okay.
We look at the top three credit bureaus, Equifax, TransUnion, and Experian. Okay. And we use the middle of those three scores. Okay. And that allows us, and we see ranges anywhere from a borrower can have a 500 credit score with one of them and a 700 credit score with the other. And it just depends on what has been reported to the specific credit bureau from a debtor.
So more out of curiosity for me, so if I go on Credit Karma, which I have in the past, like, are those real numbers that you would see, or is those sort of made up numbers? Are those, is that somebody could do some research before they call you, or no?
They can. I try and steer people away from doing that, just because a lot of times the Credit Karmas and numbers through your bank, or credit scores through your bank, or credit scores through your credit card provider, those are usually more inflated than a mortgage score.
Okay.
So it's more beneficial to do the soft pull, especially now that we have the ability to do the soft credit pull that doesn't impact the score.
Sure, absolutely.
It just allows us to get right to it and say, okay, here's where we are. And if we're not where we need to be at that point, then we can work through it. And I do that all the time with clients, whether it be a 6-month process, a year-long process, where we help to rebuild the credit score to get it where we need to be.
Okay. I remember what I was trying to remember earlier. Minimum work, like unbroken, I guess, work experience. Like 2 years, is that still the minimum you need to have before applying, or have those rules changed at all?
2 years is the standard time commitment as far as our work timeline.
Okay.
Coming out of college is different. We can use college transcripts. As far as if you're just new to the work history, whether it be 6 months, a year, we're able to use the college history as far as in the 2-year employment history.
Okay.
The hourly piece is kind of the biggest variable. If you're a salary-based employee, you could be working for your in your job for a week and qualify with the full salary. It's the hourly piece and documenting and the continuance of the same hourly wage, or the same time hours per week.
Okay.
Having the same hours per week is critical to show the stability of repayment. And so if you have 20 hours one week, 40 hours the next, 30 hours the next, when you're an hourly employee, we have to have you there for at least 6 months in order to use the source of income.
Okay. So you pull a credit score. Are there any other documents you need from somebody to do a pre-approval? Like, do they need their W-2 sent over to you? Okay.
Yeah, so what I like to do is I pull the credit score, we go over the information in person or over the phone, and then I request the documents. And for an employee of a company, 30 days worth of pay stubs, the most recent 30-day history of pay stubs, the last 2 years of W-2 forms for that job and any other jobs they've had in those last 2 years. And then we talk through the asset piece as well, as far as the source of down payment. If they're self-employed, then we like to get the last 2 years of tax returns.
Okay. Even before doing the pre-approval.
Correct. That's part of especially with being self-employed. That is a lot of folks that are self-employed show their income or think their income might be different than what they actually report on taxes.
Sure.
And so self-employed borrower is a big alert to me to make sure that we get those tax returns right away, versus somebody that might say they're salaried and they make a certain salary per year. They probably know that, and that's probably pretty reliable.
Okay.
The asset piece, as far as the source of down payment and funds that they might need for a down payment, that's kind of the third bullet point that we look at: the credit, the income, and then the assets. And the assets are not something that you have to have right at the inception of the pre-approval.
Okay.
Most people, like let's say they get pre-approved and they want to purchase a house in 6 months, 4 months, whatever it may be. They're going to get continual pay stubs or paychecks and continued income into their checking or savings accounts that they could build up over that period of time prior to actually closing on the house. So they don't even have to have the full amount of the assets required when they go under contract, because they still could have another 30, 45 days to, increase their savings or checking during that period.
Okay. And I know we've done a few deals together too where monies were gifted from family for that down payment. Is there a limit to that?
No limit to the gift funds, no.
Okay. Okay. So is there a difference between pre-qualification and pre-approval? If so, like details on those or no?
I think there is, but I don't really utilize the difference between the two. Okay. I think of it one and the same. I do all of my pre-qualifications of, again, gathering the documents that we just mentioned. So pulling the credit report, verifying the income source, whether it be self-employed or employee of a company, and then getting the bank statements for the funds they have now. So I like to fully document that prior to handing them back over to the real estate agent, so that we're not, when we get to the point of getting under contract on a new home, it's simply just updating a few of the documents we already had on file.
Okay. Yeah. So what's the benefit, I guess, you went into a little bit, the benefit of getting that done all up front? Like what could happen if you didn't do all that up front?
Believe it or not, some clients don't exactly know what they earn or they make, and they might tell you what they think they make, and then it's not what, especially with a self-employed borrower. What the top line revenue that they earn for the year will be different than the net income that they show on taxes.
Sure.
And so that's really the biggest difference, is just making sure that we have their full qualification done up front to determine exactly, so we're not wasting their time,
and
the realtor's time
down the road.
Yeah. And the biggest thing with the full pre-approval up front is really in the credit. The credit is the number one ticket item as far as determining that there aren't any derogatory items or anything on the credit that could be a problem down the road.
Okay. So let's talk about down payments, loan programs. A lot of people do think, you see it on social media, that you need 20% down to buy a home. I know that is a myth, but tell us a little bit about that range. Like, there's multiple options for down payment.
Yeah. There's mortgage options with as little as zero down payment.
Wow. Okay.
Through the USDA. It's called a rural development loan, and that is as little as zero down payment.
Okay.
There are also options for conventional buyers with as little as 3% down if you're a first-time home buyer. There's government-backed loans through the VA for veterans that allow for zero down payment. FHA is a very minimal down payment as well at 3.5%. So these are all options, not necessarily for first-time home buyers. These could be for folks that have owned a home as recent as 4 years ago. Because believe it or not, you can have owned a home 3 years ago and still be considered a first-time home buyer.
Oh, all right.
So you don't have to have never owned a home.
Interesting.
But the benefit of putting less than 20% down is becoming more and more evident over the last probably 5 years, because the providers for mortgages and the guidelines that have been put in place are putting more and more of an emphasis on credit score. Okay. And so if you have a strong credit profile, but not necessarily a lot of money in the bank or assets that you can invest into the transaction, the requirements for down payment have gotten quite a bit less. Okay. So the credit score has really been paramount as far as qualification.
Got it. I mean, is there a recommendation you go with down payment, or is it all based on what the borrower, number one, qualifies for, but also what they have in the bank? Like, what's, I guess, the most popular down payment you're seeing with the range of those loans that you described earlier?
It all comes back to, for me, the monthly payment. Okay. That's when I go through and I ask the client their qualifications, the last question I ask is, what would be the top end of what you're comfortable paying on a monthly basis? Okay. And I base my numbers off of that. And then from there, looking at the programs, obviously if they're a veteran, we look at the VA program because there's significant benefits to that. But otherwise, it's really credit driven, like I had just mentioned. Yep. Some of the benefits of the FHA loan through the Federal Housing Administration are going to be that it works with folks that have a little bit more debt and possibly a little bit lower credit score. But there's still great qualifications and options because the FHA actually offers lower interest rates than conventional loans for the most part. Okay. So it's, again, all going to come back to making sure they're comfortable with the monthly payment, paying the bill.
So most common types of home loans, and obviously you are the one that is determining what's going to work for their situation. You mentioned FHA, RD, rural development, your conventional, and then VA as well, veterans, right?
Yep.
Out there, are those the main four types?
Yeah, I would say so. Okay. There's another loan down payment assistance program through MISHDA, which is Michigan specific. Okay. And that helps with some of the down payment assistance grant options that are available. That has a little bit more limitation in reference to qualifying. Okay. So we can get into that or not, but there are options for folks to get anywhere from $10,000 to $25,000 in down payment assistance to help offset down payment requirements. Now, that loan is like a grant second lien that follows conventional or FHA guidelines. So you're still going to have anywhere from 3 to 3.5% down payment requirement. Okay. That down payment assistance goes towards reducing or covering the down payment of the standard mortgage programs.
Okay. And you have to pay that back down the road?
Correct.
Okay. Yep. Within a certain amount of years?
It's if the house were ever to be sold.
Okay. So when the house sells, that money is to be paid back to. Okay. Okay.